Follow along with this question. Please refer to the Unit 4 study guide. When you read the required for the question, it tells you to prepare the adjusting entry to estimate bad debt under each of the following unrelated assumptions. So I've divided this question up into two pieces. I'm going to have a look at part 1 and 3 first, and then we'll have a look at part 2 and 4. When you're estimating bad debt, there are a couple of different methods to calculate the number that goes in the journal entry. But the journal entry is always the same. We're always going to debit bad debt expense, and we're always going to credit the allowance for doubtful accounts. And I'm going to abbreviate that account AFDA. So we're going to debit bad debt expense and credit the allowance for doubtful accounts every single time we want to estimate the bad debts for a company. Now, different companies choose different methods to get the number in this journal entry. And in this question, the question says to take 1.5% of net credit sales. So you have to be really careful when you read the question to determine how that number gets calculated. Whenever you use sales to calculate bad debt expense, the result, the number that you get, is always the balance in the bad debt expense account. So if we take our sales and take 3% of it, the result, the 3%, is going to be what we want to end up with in this bad debt expense account. So in our case, we're going to start with sales, but the question says net credit sales. So we can't just use the $492,500. We've got to take or subtract the sales discounts from that number. And when you subtract those two numbers, you get $487,600 as your net sales number. And then we're going to take 1.5% of that. Watch your decimal places when you convert percentages to decimals. And the result that we end up with is 7314. So that number, remember, is what we want to end up with in this bad debt expense account. Now, if we look at the bad debt expense account in the T account, and we look at the additional information up here, it doesn't say anything about the bad debt expense account, so we assume that there's nothing in that account. We want to end up with 7314 in the account as a debit, so we have to debit this account 7314 in order to make that change. So that's the number we end up using in our journal entry. So we also credit the allowance for doubtful accounts for 7314 because our journal entry has to balance. Now the third part says show how the accounts receivable would appear on the balance sheet. So I'm just going to scroll down a little bit. And in the question on the balance sheet, we would have our accounts receivable account. And our accounts receivable account has $70,000 in it. The journal entry that we made to estimate bad debts doesn't affect that account at all. So $70,000 is it. The other account that goes on the balance sheet, though, is the allowance for doubtful accounts. And that question tells us that we have $900 credit in this account. The journal entry changed this account by 7314, so we have to add those two numbers together to get the balance of the account. So 8214 is the amount that we end up with on the balance sheet in our allowance for doubtful accounts. Remember that this is a contra asset account, so it's got a credit balance, and when we subtract it from accounts receivable, we get 61,786. So this is how the balance sheet or the accounts receivable would be shown on our balance sheet. Okay, we're going to do the same question again, but this time we're going to use a different method for calculating the number that goes in the journal entry. Remember, to estimate our bad debt, the journal entry is exactly the same as it was the last time. We're going to debit the bad debt expense, and we're going to credit the allowance for doubtful accounts. Now this time, to find the number that goes in the journal entry, the question says that we want to take 6% of outstanding accounts receivable. So we're going to go up here and look for accounts receivable, and accounts receivable is $70,000. Whenever you use accounts receivable to calculate the bad debts, or estimate the bad debts, the number that we get when we multiply this by 6% is not what we want in the bad debt expense account, but it's the balance in the allowance for doubtful accounts. So the $4,200, which is the 6% of the $70,000 of accounts receivable, that's what we want to end up with in the allowance for doubtful accounts. If we have a quick look at the T account for the allowance for doubtful accounts, we know that we started with $900 in the account, and it's a credit balance. The balance that we want to end up with is a $4,200 credit, and we have to figure out what do we do in our journal entry to make that happen, to go from 900 to 42. Well, we have to subtract the difference. We take the 42 and subtract the 9, and we get 3,300. That's the adjustment we have to make to the account. That's the number that goes in the journal entry. Now, when we look at this one on the balance sheet, accounts receivable hasn't changed. Our journal entry didn't change to $70,000. The journal entry did change the allowance for doubtful accounts. Remember, it started with $900. We credited the account for $33, so we end up with $4,200 credit in that account. Accounts receivable is a debit. Allowance for doubtful accounts is a credit. So when we subtract the two, we get the net realizable value of accounts receivable. So it would be $65,800. Net realizable value means how much does the company expect to collect from its customers. Customers owe them $70,000, but they're only expecting to collect